Hello. Today we're going to discuss about Warren Buffett's golden rules to investing in the stock markets. For decades, Warren Buffett has been referred to as the Omaha Oracle and the Nebraska Sage because of his ability to predict the future and his ability to achieve it. Today, he is worth an estimated $80 billion. As a youngster, Warren used to sell 6 packs of Coca-Cola for a quarter apiece, collect and sell golf balls, and even enlist the help of other kids in his neighborhood to help him out with his business venture. Warren assesses the management team throughout the acquisition process to see whether they are skilled and competent. Then, he invests in the business by purchasing shares. Number 1. Warren's policies are not purchase 100% stake in a company, but rather to own a non-controlling but significant portion of the company. After all, when you own thousands of companies, who has the time to run them all, right? Number 2. With over 30 years of experience, Warren has invested in a diverse range of businesses ranging from lollipops to jet airplanes. Some of the businesses, as measured by earnings, have produced profits ranging from 25% after tax to more than 100%, while others generate good returns in the range of 12 to 20%. However, a few of the businesses in which he has invested have produced extremely poor returns. These errors, on the other hand, are generally minor blunders in the overall balance sheet, so keep your blunders to a minimum and don't be afraid to take a calculated risk when the opportunity presents itself. Never gamble with your money, but rather put it into a business idea that has strong possibility of succeeding instead of gambling with it. Number 3. Understand when it's appropriate to fold them. Even though Warren Buffett has been extremely successful, he has made a few bad investments in the past. He famously learned this lesson while betting on horse races and tried to make up for his losses by increasing his bets, but he ended up losing even more money. You must be able to recognize when a stock is a genuine loser in order to be able to walk away and minimize your losses. Number 4. Focus your attention on the future productivity of the asset you are considering investing in. If you don't feel comfortable making a rough estimate of the asset's future earnings, forget about it and move on. No one has the ability to evaluate every investment opportunity, but omniscience isn't required. You only need to understand the actions you're taking. Warren Buffett believes that you don't need to be an expert in order to achieve satisfactory investment returns, but you must recognize the risks involved. Number 5. When investing in stocks, if your attention is drawn to the potential price change of a stock you're speculating, there is nothing wrong with this. But you should be skeptical of people who claim to be able to accurately predict the future price of a stock with no solid evidence to support their claims. Half of all coin flippers will win their first toss, but none of those winners are guaranteed a profit if they continue to play the game the fact that a given asset has appreciated. Number 6. Dividend-paying equities are excellent investments. Warren Buffett, like the majority of investors, enjoy dividend-paying stocks. His firm receives millions of dollars in dividend from dividend-paying equities each year. A great benefit of purchasing a company is that dividends are paid out regularly, which usually indicates that the company's finances are in good enough shape to pay its investors a portion of their profits. However, if you prefer companies that have had a long history of paying dividends, these stocks may not make you a lot of money immediately. However, their dividend, if reinvested, should make you a lot of money after a few years. Number 7. Do not keep an eye on your equities every day. As Warren Buffett recommends in his yearly report, when I made my 2 tiny investments, I was just concerned with the income of properties would provide and had no interest in their daily prices. Games are won by players who maintain their concentration on the playing field, rather than by those who keep their gaze fixed on the scoreboard. If you can't get away with not glancing at stock prices on Saturdays and Sundays, you should give it a go on weekdays. It is a waste of time and even dangerous to form a macro options or listen to macro or market predictions made by others, because it may cloud your vision of the facts that are truly important, such as the annual report of the business, future plans if they have any, the management team's competence or incompetence, and other such things. Number 8. Set your feelings aside. Owners of stocks, on the other hand, are much too frequently influenced by their emotions and the illogical conduct of their fellow investors to act reasonably themselves. Because there is so much talk about the markets, the economy, interest rates, stock price behavior, and so on, you get overwhelmed and make illogical judgments as a result of the information overload. When some investors hear chit talk about an inside trader offer they can't afford to miss out on, they get enraged and, worse yet, they act on this bogus information without taking the time to investigate if there is any substance to the information they've been given. This point of view, always be cautious when taking investing advice from people who are unfamiliar with the stock market. The point is to avoid making life-altering financial decisions based on tips or rumors that you may have overheard. Never take investing advice from friends or people who are unfamiliar with the stock market. If your best friend or coworker is advising you to invest in a particular stock or business, don't just go ahead and do it. Make an in-depth analysis of the data that he or she is offering. Inquire about their sources and who provided the information. It could really be a solid suggestion, but perform your own due research before investing in anything. Warren Buffett thinks that you must separate your thoughts from the rest of the herd. He said that it is difficult, but you must stand out from the crowd by building your own investment plan based on your skills and experience in order to succeed. In order to be a great investor, Warren Buffett said that you must dissociate yourself from the fear and greed of others around you, which is almost hard to do. Number 9. While a flash collapse or other severe market volatility is very detrimental to the typical investor, it is detrimental to the seasoned investor because while other investors are seeing red flags and smoke everywhere, the seasoned investor is able to capitalize on the opportunity. Indeed, plunging markets may provide a fantastic chance to reveal real investor if he has sufficient cash on hand. Thus, it is always advisable to have a cash reserve for such occasions. When it comes to investing, Warren said that a climate of anxiety is your friend. A climate of euphoria is your adversary. Never bite the bullet and always have cash on hand for such times because the market will bounce back. It always does. Number 10. When Warren and Charlie purchased stocks, they considered themselves to be purchasing a share of firms. The process they used to buy stocks is very similar to the process they used to buy entire businesses. They first determine whether they can reasonably estimate earnings range for a 5-year period or more. If the answer is yes, they will purchase the stock or business if it is selling at a reasonable price in relation to the bottom boundary of their estimate. If the answer is no, they simply move on to other prospects. If they lack the ability to reasonably estimate future earnings, they simply move on to other prospects. It has been 54 years since Warren Buffett and Charlie Munger began working together, and they have never forgotten or tracked a purchase because of the microeconomic, political, or public opinion environment. In fact, these subjects are never brought up when they make investment decisions. Don't let small circumstantial issues prevent you from making a good investment. Number 11. Most investors, by their very nature, have not made the study of business prospects a priority in their lives, and if they are wise, they will conclude that they do not know enough about specific businesses to predict their future earning power. However, Warren Buffett has a good news for these non-professionals. The typical investor does not require this skill in aggregate, and American companies have performed admirably for a long time and will continue to do most assuredly in unpredictable fits and starts. Number 12. Never stop learning new things. Warren Buffett likes to say that knowledge accumulates in the same way that interest does in a bank. He has stated that he simply sits in his office and reads for a minimum of 5 to 6 hours a day. That he reads hundreds of pages from books, that he reads hundreds of pages from corporate reports, that he reads hundreds of pages from newspapers, and that he estimates that he spends as much as 80% of his time on average reading. During an interview, he said that he read 500 pages like this every day since this is how information works. It accumulates like compound interest. He also stated that although everyone may do it, he believes that few people would do it. These are just 12 habits that Warren Buffett and other successful investors use to become wealthy, and by adopting these habits, you will be much better equipped to become wealthy yourself. Thank you for watching, and please give us a thumbs up and consider sharing and subscribing to our channel. Please leave a comment below if you have any tips or advice, and I'll see you in the next video.